Rob, Barry, good morning. I've had the opportunity to look at the proposed terms that you received from Drexel Venture Capital Partners. At this point, you should have three items in front of you. One, my suggested changes to the anti-dilution provision, some scenarios as to how this provision would work using actual numbers, and a capitalization table. Do either of you have any questions before we get started? Okay, in that case, let's start by taking a look at the cap table. I know you both had questions about the anti-dilution provision, but before we get to that, I think it would be helpful to go over this table. As you can see, the table shows the equity interest in the HealthLawCom before and after the proposed investment in the company by Drexel. I believe that this is an important illustration of the equity structure of the company and ensures that we're all on the same page going forward. Furthermore, this table can be updated on an ongoing basis as future rounds of financing commence or the valuation of your company is redetermined. But a few notes before we move on. First off, I'm assuming that you're both 50-50 owners of the company. If this isn't the case, please let me know and I can update this information. Second, the pre-money valuation of $8 million is based on Drexel's offer of a $2 million investment for a 20% equity stake. And I think we should go with this number, but please keep in mind that we can always have another party value the company if you're willing to bear that cost of the evaluation. Third, the table does not reflect any options, warrants, or other securities that may be issued to compensate you or your employees in the future. If this is something you think will be useful as the company grows, I can certainly add it to the table. However, to maximize their investment, Drexel is likely to insist that any option pool be created before they make their initial investment into the company. And then finally, just please note that the percentages related to common stock post-money reflect each party's equity stake in the company. Voting rights and the operation of the board of directors will be addressed elsewhere in the agreement. Now, moving on to the anti-dilution provision itself. Drexel has a legitimate concern that their investment may be diminished over time as new investments are made in the company at a lower price per share. This is the purpose of the anti-dilution provision. It appears that Drexel has chosen the full ratchet approach based on what they sent over. Under this full ratchet approach, the conversion price of the Series A preferred stock will be reduced to a price equal to the price per share paid by any subsequent investors. This will lead to the same result regardless of the size of the future investment. The problem with this approach, at least from our point of view, is that you'll be bearing all of the downside price risk while there's no limit to the upside potential for Drexel. In addition, as the equity held by the common stock owners decrease, and assuming that the common stock owners are the employees of the company, their incentive to work towards the growth of the company may diminish as well. Alternatively, we could remove the anti-dilution provision in its entirety. Theoretically, although Drexel may be diluted in terms of the percentage of the company owned, if a new issuance of stock is made at a price per share greater than the pre-money conversion price, this will mean that Drexel's real investment in the company has grown. However, it's unlikely that any venture capitalist would be willing to take on this risk, and if we insist on going down this road, we'll likely kill the deal. So therefore, I've marked up the anti-dilution provision to reflect what's known as a weighted average formula. There are two basic variations to this formula, broad-based and narrow-based. A broad-based formula will consider all the outstanding preferred stock on an as-converted basis and any outstanding options and warrants in addition to the outstanding common stock. On the other hand, a narrow-based formula would only consider the outstanding preferred stock of any of the particular series. But since Drexel's investment will be the first round of financing for your company, the effect of the weighted average formula should be the same under either the broad-based or the narrow-based approach. And then, if you look at the provision, you'll see they add a second section, cases which the provision will not be triggered. While Drexel shouldn't object to number one in the event of like a stock split, they may quibble about numbers 2 and 3. My thinking was there should be some variance built in for slight differences in the valuation of the company by future investors, and that small issuances would not have a material effect on Drexel's equity in the company. Realistically, if the company is only able to obtain financing equal to 5% or less of the enterprise value, the company's likely not going to make it anyway. But neither of these two last provisions should be a deal killer, and I'd be fine bargaining them away for something else. So then finally, I just outlined 4 examples as to how this anti-dilution provision would work. I think it's pretty self-explanatory. Example 1 shows what would happen, a new investment above conversion price. Example 2 is a new investment at a per share price below the conversion price, and that would kick in the weighted average formula. And then items 3 and 4 are those last 2 items that I mentioned. Company. In example 3, the company issues shares at a slightly below pre-money conversion price, in which case Section B2 would not trigger the anti-dilution provision. And then finally, example 4 would be at a drastically reduced price per share, would actually lead to only a 2% pre-money valuation. Excuse me, let me repeat that. So example 4, if a company issues 20,000 shares at $10 per share, this financing would only represent 2% of the pre-money valuation of the company, and then that anti-dilution provision would not apply under Section B3. That's all I had. I hope that answers your questions. Is there anything else you'd like to discuss? If not, great. Please give me a call if anything comes up. Otherwise, I'll be in touch with you soon. And I thank you for your time.